All right, let's jump right into today's explainer looking at the market for May 26th, 2026. If there's one phrase I'd use to describe crypto right now, it's absolutely survival of the fittest. We are literally watching the market ruthlessly filter out the weak in real time. Forget the Wild West you might remember from a few years ago. Today's market is all about who actually has the structural, financial, and regulatory foundation to survive. So we're dealing with what we call quality consolidation. It's basically the old era of reckless speculation. The farm and dump token models and empty promises going head-to-head with today's reality of strict regulatory compliance and sustainable revenue. The gap between these two, it's never been wider, and capital is flowing entirely in one direction right now.
Part 1. The filter, Europe's exchange squeeze.
14. Yeah, just 14. A brand new legal bison analysis just dropped, and out of 174 registered crypto asset service providers, only 14 currently have the legal standing to operate a centralized exchange in the EU under MiCA. I mean, think about that ratio. Less than 10% of the players actually have the technical and regulatory chops to run a trading hub right now.
So the real takeaway here is this exchange squeeze is going to force liquidity to pool into just a handful of surviving super exchanges. The non-compliant platforms are just getting entirely filtered out. For European traders, you're trading that old, wide-open access to thousands of random platforms for a highly restrictive but super stable institutional-grade environment. The Wild West saloons are closing up shop, and the heavily guarded banks are moving in.
Part 2. The survivors. Institutional accumulation.
Despite all that recent chatter about using holdings for dividends, Michael Saylor's strategy just scooped up another 535 Bitcoin. That's a $43 million buy. And the way they did it is what's really fascinating here. They boldly funded this entirely by selling company common stock, literally monetizing traditional equity to buy up digital scarcity.
This is a brilliant example of strategy leaning hard into their digital credit model. It's aggressive accumulation funded by traditional financial engineering. And honestly, it proves that the big institutional floor doesn't care at all about the regulatory friction we just talked about over in Europe. They are playing a totally different game, using Wall Street tools to build an absolute fortress on the blockchain. But it's not just about buying Bitcoin. It's about moving the money. We're seeing institutional roots spreading deep into infrastructure now. Mirage just grabbed a ton of attention by announcing a seed round and closed alpha for private stablecoin transfers. And their target? Corporate transactions. Institutions want the speed of on-chain stablecoins for sure, but they absolutely need privacy for their ledgers. And the market is finally building the compliant tools to make that happen. Even retail marketing is growing up. We're way past the flashy fly-by-night gimmicks of the past. CoinW is blending traditional sports with finance now, partnering with football legend Luka Modrić as a global brand ambassador. It's a highly calculated move to build trust across European and Asian markets. These surviving exchanges are clearly positioning themselves to be legacy, household brand names. Part 3. Value over speculation, the Lido pivot. Lido is currently riding a massive 30% monthly rally. That is some serious outperformance against a broader DeFi sector that has basically been totally flat. It is crystal clear. Investors are heavily rewarding protocols that offer actual, tangible utility and leaving the speculative farm and dump models out in the cold. And the catalyst wasn't some empty marketing hype. The Lido DAO successfully passed a protocol buyback scheme. This is a huge evolutionary leap into sustainable revenue sharing. Instead of inflationary reward emissions, they're using protocol revenues to buy back tokens, shifting the narrative entirely to real value capture for their token holders. It's exactly the kind of maturity the market is begging for right now. Part 4. The dinosaurs, a retail cautionary tale. So I want to pose a question to frame a strictly factual, pretty significant concern that investigators have flagged for retail today. What exactly happens when massive marketing hype collides with the fine print? Well, the answer is a frankly staggering number: $60 million. There is currently $60 million in unfulfilled deposits just sitting in limbo for a Trump-themed gold T1 phone. We are talking about tens of thousands of retail buyers waiting on a device that hasn't seen a single confirmed delivery yet. Back in April, the terms of service for this device were quietly rewritten, entirely removing delivery guarantees. It's a really painful reminder of the massive risks and bad debt lurking in the hype-driven corners of crypto. While institutions are busy building compliant credit models, everyday retail buyers are still getting caught up in unfulfilled promises. It perfectly illustrates that quality consolidation divide.
Finally, Part 5, the horizon, technical breakout targets.
Bringing all this structural evolution back to the charts, you can see the roadmap mapped out by analysts. Support is holding strong right now at our consolidation zone, somewhere between $74,000 and $75,000. If that foundation holds up against macro pressures, analysts are eyeing a potential 10% rally. We're talking a double bottom breakout targeting 82,500. Hitting that target would be huge, because it means finally smashing through what traders are calling the persistent Fed ceiling.
So, what's your actionable takeaway from this explainer? Watch that $78,500 metric, the true market mean, really closely today. It is the immediate momentum trigger. Crossing and actually holding that exact mathematical threshold is what's going to determine our next major market shift. It's the line between further consolidation and an explosive move upward.
I'll leave you with this to chew on today. As the market wraps up filtering out the weak and the big players build a hardened institutional floor, if Bitcoin actually confirms this breakout toward $82,500, will it finally be the spark that jolts the retail market awake from its multi-week stagnation? Thanks so much for hanging out with me for this explainer. Keep your eyes glued to those charts, and I'll catch you next time.